Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are modeling out the impact of coronavirus. Phil, it's great to have you with me, as always. And the story today seems to be U.S.-China trade tensions and kind of a disappointing retail sales number.
Yeah, I was going to say the story today seems to be a lot about retail, and definitely some of the charts that we've been looking at this morning are all about retail. Obviously, the number was expected to be bad. It was a little bit of a negative surprise, but it's just good to get a yardstick on how bad and which sectors have been affected, given that retail earnings coming through next week. So if we look at the data came out, it was like a 16% plunge in retail sales, but it's across a lot of the sectors that we've been talking about as being worse hit. So clothing, furniture, electrical, bars and restaurants. I mean, surprisingly, that's not down 100%, but they're all the worst sectors. And then you've got grocery and other sorts of, staple stores that are actually up. So the retail spending is mixed. It's going to affect companies differently, obviously. But it's highlighting that a lot of people can't shop and a lot of shops are closed, which we expect. So the market didn't react that strongly to the actual number. And you're right, the market's probably reacting more to the geopolitical concerns that are out there. There's a couple of different things targeting China overnight. One of them is looking at the Chinese companies and whether their accounting quality, if they're listed in America, is up to scratch, and potentially getting a little bit stricter on that. And then also whether Huawei can get chips from American producers. So that would escalate the trade war in a new sort of way as well.
All right, let's take a look at our first set of charts today with an update on COVID-19 cases. It doesn't seem to be as if there's much new news out there.
Yeah, which I guess is a good thing. The US, we have the highest cases, but we look like that we've definitely passed peak and there's a slow downward trend. It's a shame that we haven't got the same downward trend of even a country like Spain, which it sort of avoided the early press, but it's ended up with the highest per capita caseload. They've really seemed to have crushed their curve and got the new cases under control. And then obviously Germany is one of the countries that people talked about as a sort of example for the future with good testing and reasonably good tracing. And they've started to open as early as April 20, so nearly a month ago now. And you can see they've had a couple of spikes of new cases, but they haven't had a second wave, which is great news for the rest of us if we can learn what they've done right to get people back to work and sort of start to reopen the economy without causing a second wave.
All right, moving along to our next charts here. There is a little bit of silver lining to the economic data, as pointed out in these couple of charts here, where the shutdown was sharp, but it didn't trigger that wave of additional closures that was expected.
Yeah, and we've talked about some of the daily data that showed the number of companies that shut down in that middle week of March. We went from sort of 100% to 50 to 60% closed, and it stayed at about that level. So I guess the risk was we knew that there was a sudden shutdown. What about if those closures triggered other closures, which triggered third wave of closures? And the data doesn't seem to have indicated that on the business opens and the hours worked. We're actually starting to see some green shoots, I would say. So the economic indicators that we're looking at here have stopped falling for the most part, sort of stabilizing. The same store sales has bounced a little bit. Hours worked bounced a little bit. We're starting to see some people get back to work as well.
All right, and if we wrap up with our last set of charts here, looking again at that retail data, as you were saying before, it's really going to depend on consumer demand and just how comfortable people feel unleashing that cash that's on the sidelines.
Yeah, and these two charts are pretty positive. I mean, you can see we've definitely bottomed in retail and the people are starting to spend again. So opening the country up is starting to bring people back into retail. Obviously still well down from average levels, sort of 40% below normal, but on the right trajectory. And I think the right-hand chart is even more useful because it's looking at search history. And so it's showing that people are starting to think about getting back out and buying things, which speaks to why people thought we might have a V-shaped recovery. And so that's good news that people aren't hunkering down and changing their behaviors entirely. We're all looking forward to getting out and getting back to normal, and we're ready to go spend the money, I guess, we've been saving by sitting at home and cooking food for ourselves.
Yeah, definitely co-sign that. I'm looking forward to it as well. Phil, thank you so much for everything, for joining us on Trade Talks.
You're welcome, Joe.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.